Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Wednesday, April 16th, 2025. Today's episode begins with our headline, Powell said, "Cry harder." Jerome Powell, the head of the Federal Reserve Bank that controls interest rates, that basically controls the value of money, spoke today in Chicago, and he essentially said, cry harder. We're not here to save the stock market. We're going to be patient. And some of the quotes from what he said included referencing break-evens. This is something that I bring up on almost every show lately while gold is going up and Bitcoin is high and people are like, uh-oh, inflation. There's a market with trillions of dollars that basically prices this with what's considered to be the smartest, biggest, most powerful money in the world. This is the break-even inflation rate. He stated correctly that it is basically near 2%. And ever since this tariff scare came in, this has not been flying to the upside. So no reason to tighten. If anything, we're looking at when do we start loosening here. Even today, specifically, we had a new lower low, dropping to 2.17%. Expected inflation over the next 10 years. This uses Treasury protected inflation securities, comparing it to the regular 10-year yield. In a nutshell, it means that the market is pricing. People are betting enormous amounts of money that inflation will average 2.17% over the next 10 years. Not 3%, not 4%, not 20%, not 100%. 2.17%. Powell in today's talk also said, and I quote, "Unemployment is likely to go up as the economy slows and inflation is likely to go up," referencing what's going on with tariffs. He did mention that he sees tariffs as a temporary price increase, not something leading to further inflation. He also stated very explicitly, we are well positioned to wait for greater clarity before considering adjustments to our policy stance. In other words, we're not budging. Cry harder. We're not going to do a darned thing. This is in line with my crystal ball reading that I've been holding for a very long time now, stating that the Fed won't cut fast enough to save the economy. The previous two cycles, especially the dot-com bust and the great financial crisis, the Fed came in and did an enormous amount of saving everything and everyone, and also with COVID. This time, well, he's not interested in saving it, not yet. The thing that I think strengthens this idea is that in every previous cycle, really, I'd say for the past 35 years, the Fed has tried to get in front of unemployment rising. They've tried to front run potential problems coming in the future. Right now, he's saying, nope, cry harder. While I was recording yesterday's show, Mr. Market apparently dropped the other shoe, and that leads us to our second headline. Mr. Market waited for the other shoe, and it dropped. Being the semiconductor industry, not only did Nvidia come out saying we're gonna, lose a bunch of money because of policy changes, AMD also came out with similar bad news about their company's earnings. And so not only did SMH, the semiconductor ETF index, drop by a whopping 4.2%, which whopping, what's whopping anymore? Also, the triple Qs, the entire NASDAQ dropping by 3% today. Overall, one thing that's kind of giving me a little bit of comfort is it is very jolting and upsetting for market participants, especially in the investing world and the entire business world, to be getting changing news going back and forth. One day there's a tariff on this, next day there's a pause on that, next day there's a new regulation here, a new regulation there, a new deal here, a new deal there. It's causing a lot of volatility. One thing that is giving me, and I think a lot of other market participants, a little bit of solace is Powell coming out and saying we're not playing games here. We're not flip flopping around. We're waiting for greater clarity. So thank goodness that there is something involved right now with all of this that is, sitting on their hands right now and waiting for things to settle, which I think is wise. I think it's good. No political opinions. There were definitely interesting chart developments today. We will look at those when we get to the charts. Before that, community topics. Love hearing what you guys are doing or not doing. What moves, if any, did you make today? I love the conversations in the comment section. It's like almost a Reddit forum at this point, and I love it. I'd love it to continue. For me, I just sat on my hands today. I didn't do anything. Coming up, very near or in the, I mean, who knows how long. We still are looking forward to continuous tariff updates, which are like rolling the dice at this point, the 20-sided die at that. And we have initial jobless claims coming out on Thursday, which could affect things. And then Friday, markets are closed. As always, thank you for watching, subscribing, commenting, and supporting. These are the daily reminders. I will eventually have to redo this just because it's been over 2 months, but to hear me explain most of this stuff, watch up Macro Update 21125 and watch Portfolio Update 21125 to hear me explain my crystal ball ratings and most of my portfolio. On to the charts, starting with the S&P 500, SPX dropping, closing 2.24% down today. This is normally a really big move down, but in light of recent volatility, this is actually normal at this point. We haven't been waking up for a while expecting the market to move less than 2 to 10% in one day. Based on Shiller Cape ratios, PE ratios, it tells me the S&P 500 is still priced like a Ponzi scheme, so I still favor downside. It would only make sense to me. The VIX, the fear gauge, the fear index, whenever it's above 20, it's considered that the market is in chaos mode, and chaos mode rose slightly today. There are rumors of a White House press conference coming out today, and that could send this going way up, could send it going way down. If all the deals in the world were made and everybody's happy, maybe the VIX can cool off here. More likely than not, we're still waiting for another shoe to drop. I know I said the second shoe drop, but Mr. Market has a lot of shoes. High yield corporate junk bonds are settling, is how I would describe it at this point. And that is actually bullish for markets overall, because when you don't have crazy volatility in the money that people owe, if when companies owe way more interest payment on their debt, it's like it just strips the legs right out of the stocks, and so for this to be stable here, it can give a lot of legs to the market going higher. Although, with volatility, if volatility increases and we get like another big down day in stocks, this could easily collapse. But I find it notable that high yield corporate stayed pretty calm today, relatively speaking. With TLT rising over the past 4 days, one must wonder if this is simply normal market movements. We were all talking about how ever since the first tariffs were announced, how the 10-year Treasury note was spiking and TLT was dropping through the floor, and everybody's like, how high is the debt gonna go? How high are interest rates gonna go? Everyone was flipping their lid, and we hit the pause button, and I'm wondering if we didn't hit the pause button at all, if this chart would look actually that much different, to be honest. If you just look back to December, yes, things have gotten quite a bit more volatile, but we go up and we go down and we go up. This is not like trending higher. It's not trending lower. We're kind of just flopping around in the same range. And so I'm starting to wonder if interest rates are sort of acting a lot more independent to other market factors than most people think. It's sort of what I'm getting out of seeing the charts right now. As smart money is in bonds in the bond market, it's still emotional, and there are still wild things that happen, and there are entire countries involved, institutions involved, hedge funds involved, lots of players with their own things that they have to do involved with this. And with things getting so crazy, like, it's easy to put a story on something that you see on charts and have it be completely irrelevant, but that's why we have our crystal ball. I wanted to bring up crude oil today because we had been getting in the past 3 days very, very small candles. In other words, tightening, tightening, tightening. We finally broke, and we broke to the upside. This is not abnormal. Most people are looking for basically 65 to be really the resistance point. So at this point, it looks like we are likely to get to that 65 before, I assume, going much lower. I went short gold miners using the fund GDXD. This is a chart of gold. I went short there. I think it was Friday. It was here. It was at this level because I thought we might go straight back down. Instead, we went straight up. There is longer term strong resistance at the 3400 level. Chartists that I listen to are expecting to hit this before getting rejected, and the big support channel is still support level rather is still at 2900, and so I am expecting this to be our path moving forward in gold, and I'm still holding the short that I have. With the 10-year treasury note dropping and Powell coming out and saying cry harder, basically, we flipped back below the zero line into strangulation mode, at least temporarily. I can't help be astonished that how zero has acted as sort of a magnet for the 10-year minus 3-month treasury, going above it, going below it, above it, below it, above it, below it. Amazing. Like I've said many times before, the longer we are at or below zero, the longer the markets are being strangled by rates that are perceived as too high. In other words, how are we going to afford these interest payments? We can't. The rates are too high right now, which means we've been getting strangled for over 2 years. And usually when that happens, a recession or something worse happens pretty soon after. First time in history that doesn't happen. I doubt it so much that I am betting most of my assets on it basically at this point. But you remember, guys, I'm just a guy with a crystal ball and a pet dragon named Drakmar. Not all stocks went down today. One of my stock holdings, MSOS, I haven't brought this up in a while. It has just been finding no bottom in sight, but today it went up 4.5%. I'm still of the opinion that I don't think this entire industry is going to die, and I think there are winners that are going to come out of it, and I think those winners exist in this fund, although I don't know who the winners are, and I don't really care. I just know that a new market, after dropping over 95%, diversified with all of the companies in the US that exist that produce this stuff, has enough safety and potential return for me to hold and potentially build more into the position at this point. Like Powell said in his speech today, quoting Ferris Bueller from Ferris Bueller's Day Off, it certainly is exactly how everyone is feeling right now, especially markets, and things are moving so fast through my crystal ball I can't even see them. I have no idea what's coming next. I'm sure a lot more shoes and cans of chicken noodle soup. But what do I know? I'm just a guy with a crystal ball. That's all for me and my crystal ball. Hope you enjoyed, and thank you for watching, and see you next time. Robschild.